Recipes for technical trading success in Cook's Kitchen.
Is the stock market going to top before the Fed raises interest rates next month? Well, the Fed may not raise interest rates, but if you had asked me this question a year ago, I would have said, no way is the stock market going to top before the Fed raises interest rates, because the Fed is still a huge tailwind. Even in early 2016, Fed funds is not going to be at 1%. Big tailwind in an economic expansion that's still going. Now, if you'd asked me yesterday, will the stock market top before the Fed raises interest rates next month, I might have said no again. But Tom McClellan, you've probably heard that name before, famous family that created the McClellan oscillator. Tom McClellan this week is calling for a stock market top, and today was his day. Stock market is paying attention, following suit, and looks like we're going to crack that 2050 level on the S&P. So I've been cautious since June because stock market breadth is breaking down, and the market is, after 7 months of grinding sideways, rolling over. Let's take a look at the breadth and the stealth correction that's been going on. First up is the NYSE advanced decline line, the cumulative measure. And Tom McClellan actually points to this as being a marker of a possible stock market top, because he's looking at this red arrow right here that I drew in of, the advanced decline line continuing just to creep down here. This is since we peaked in March. The advanced decline line just continues to grind down, and you see it, this is August 20th here, making new lows. Taking out that July low there. So that's interesting. What I want to point out, though, about the cumulative NYSE advanced decline line is that these green ellipses, look where it goes sideways. So for much of 2013, which was a great year for the stock market, the second half of the year, the advanced decline line went sideways before it broke out again. Then we did the same thing in 2014. So I don't think you can call a top in the stock market just because the NIAD is doing this. All right. Next, we are going to look at the S&P Equal Weight Index. This is one of my favorite simple breadth measures because you just look at the S&P 500 on an equally weighted basis, and it strips out the power of the mega caps like Apple and Google, and it tells you what is the average stock doing in the S&P 500. This one has been rolling over and breaking down. Let's get the update here. So this is as of a couple hours ago on August 20th. And I just want to note here, look how it's been living below its 200-day moving average for all of July and basically all of August. We had a brief respite here. This plunge here was when the S&P went down to 2052 on the yuan devaluation last week. Recovered nicely. We get back up above S&P 2100, and that put the S&P Equal Weight Index back above its 50 and 200-day moving averages. But now people are going to start talking about a death cross here, just like we've had in the Dow, where the 50 and the 200 are crossing. Again, this is just the equal weight. The conventional index isn't doing that. But the other thing to notice here is this sort of long process of a top and rolling over. And the equal weight index was giving you those clues in late June and July, and that's why we became more cautious. I scaled back market timer exposure. We're we're 35% long in market timer, the ETF timer. And in my growth stock portfolio, FTM, follow the money, we are now at 35% cash there. So, and just thinking, hey, we lose 2050 on the S&P, we're going to go to 2,000 pretty quick ahead of the FOMC next month. All right, next breadth measure to pay attention to here. This is the total U.S. market net new highs. So new highs minus new lows. The green line is zero. Look at where the stock market tends to live in a bull market. Makes sense, right? Here's 2013. Here's 2014. You live above zero most of the time. You have these flushes, these plunges below the zero line. This is the October correction of 2014. 1,000 new lows, net new lows in one day. That's the kind of action you get. But, so what I want to draw your attention to here is my red ellipse. Look at where the net new highs has been living for the summer. It's been spending a lot more time below the zero line. Not a plunge. I mean, some plunges and recoveries, but then right back down. And this late July plunge coincides with other breadth measures, sort of a capitulation there. The market recovered. It's possible we recover from this. I'll show you some other breadth measures that show that we can go sideways here and recover. But this has been a bearish indicator and a bearish warning when the new lows start to pile up. And we've seen half of the S&P 500 in correction territory, half of the S&P 500 below the 200-day moving average. So a lot of stocks getting taken to the woodshed in the big average, even while the index hangs out at 2,100 within 2% of its all-time highs. All right, what do I have next for you? Here we go, the percentage of stocks above the 200-day moving average. Now, I went out here and took a longer look. This is like a 4-year chart because I wanted to show you what happens in 2011, or what happened in 2011, what things look like. First, let's look at this red line. I drew a red line at 70% of S&P stocks above their 200-day moving average. Why 70%? Well, because that's where the market tends to live in a strong bull market, right? All of 2013, good chunk of 2014, we had the plunge. Here's another V move, right? Just like on the new highs minus new lows, you get a plunge and recovery. But what started to happen here in the summer? Started living. We broke down below 70, 65% and living down here, 50, 55% on the number of stocks above their 200-day moving average. Sign for caution. Let's see what happened in 2011. 2011, not only do we have this big plunge where you can go down below 10%, 10% of S&P 500 stocks above their 200-day moving average. So the market's just getting wiped out. How long did that go on? Let's go back to the chart here. It went on, for a while, because remember, in 2011, during that correction, we were dealing with a dysfunctional Congress, right? Brinkmanship. And so the market spent a good 2 months bouncing between 1,100 and 1,200 on the S&P, and that's why this indicator was bouncing here. Now let's look what happened in 2012. In 2012, we had more dysfunctional Washington, D.C., and more brinkmanship as they're fighting about the next budget and that sort of thing. And the percentage of stocks above their 200-day moving average, sort of consolidated in a negative territory, say between 50 and 70%. And then it recovered, then it dipped again. So, this is not, the worst correction we had in 2012 was barely 10%. So this is not like, all out, here comes the bear market type of bearishness. We barely got a 10% correction in 2012, and this is what the indicator was doing, the breadth of the market, so to speak. So that's where we are now. So that's why I wrote this week that, hey, could the stealth correction be over? That's what we need to pay attention to here. And my thesis was, hey, we bounced off of S&P 2050. If we can hold it, then the stealth correction could be over. There is no real catalyst to make a rally for new highs before the FOMC in September. But the market just could continue to chop around sideways. And we're going to look at periods of long chop like this, 6, 7, 8 months. But here we are. And as I speak, probably the S&P is giving up S&P 2050, which makes me answer the question, is the stealth correction over? No, it's probably going to continue now if we lose S&P 2050. All right, what's up next here? Okay, this is from Urban Carmel at the Fat Pitch blog, and this is 1991. Actually, this chart goes all the way back to the middle of 1990. Down here at these lows is the middle of 1990, late in the fall, all the way up through early 1995. Why is he showing this? He's showing in a bull market that was, getting rolling after the recession, the 1989-90 recession. Bull market's back on. Look at these long periods of consolidation. He counts 5 of them between 1991 and 1995. And, these are on average 5-6 months. Some were longer. Some had a nice 10% correction within them. This one here in 94 went from S&P 480 down to 440. Doesn't that sound funny? S&P 480 down to 440. But, there was your 10% correction back then. It would be a 2-day blip here. So, I already advanced my next chart. Let me make sure I didn't go too far here. So, the point of this chart, courtesy of the Fat Pitch blog, is that bull markets do this. They can have these long consolidations, and I picked this one because it had so many in a 4-year time span. You had 4 of these choppy sideways meat grinders. So they happen. All right. Next, we're going to look at my favorite indicator for finding the capitulation bottom when it happens. This is another net new highs indicator. So you take new highs minus new lows. But this is, instead of on the total market or on the NYSE, this is on the S&P 1500. So it's the S&P 500, the small cap 600, and the mid cap 400. And it's called the HighLow Percent. So instead of looking at net new highs on a issue basis, it's looking at it on a percent basis. And we used this last fall to predict and time a bottom pick, and we did it very well because I was already looking at this indicator in advance of the October correction. We started looking at it in September, and I said, look where this has lived. This is, for this bull market, all of 2013 and most of 2014, it barely gets below 0%. And I should have drawn a line here, but this is the zero line right here. All these lows, barely gets to minus 2.5%. And I said, we're due, because in 2012, we dipped to, below minus 5%. I said, we're going to get one here. We're going to get one that's really we need a washout. And we got this one down to 10%, and I said it would happen again. And that's the capitulation or washout you're looking for when everything's getting thrown out. And if you're still in a bull market, if there's no sign of recession, then those are the liquidity events that you want to buy. All right, so let's see where how things look coming up here. What have we done? Remember I showed you that net new highs minus new lows made a plunge in late July? Well, that showed up here in the SUP HLP. By the way, if you want to look this up on stockcharts.com, just type in SUP HLP and you'll get this indicator. Now this data is 2 days old. And it doesn't really matter because I'm just showing the general position of this. So what I'm looking for is another plunge to 10% or lower to give me my capitulation marker and make me a better buyer of the stock market. And so that's one you want to have on your radar as we break down here, which we are probably doing. And I think if we lose S&P 2050 here, since we bounced off it so many times, we probably go to S&P 2000. And then the market, sorts it out. It's going to have some bounces, bounce back up to 2040 or something, probably come down and test 1980. And this can all happen in the next 3 to 4 weeks before the FOMC. Lots of jitters. The FOMC raising rates shouldn't tank the market. And if they hold off, that'll probably give a good excuse to rally. But we're in an interesting time right now with lots of global jitters, currency wars, and the Fed is supposed to come off of quantitative easing while other central banks continue to push it. So I think equity players just have to focus on what are the fundamentals of the economy and is the Fed still a tailwind. And when they do that, they're going to be better buyers of these dips, whether we get a 5% correction or a 10% correction all the way down to below 1950. All right, I think that was my last chart to show you. Let me just double check. Yes, it was. So that's Cook's Kitchen for this week. Watching the market roll over, distribution heating up, and we're going to find out very soon how far this correction goes, where it ends. Check back next week. Hopefully I'll have some more data about it, and we'll be looking to pick our spots to buy this dip. Thanks for watching.